What's brewing? Home and sleep solutions company Wakefit has posted its FY24 financials, marking a return to EBITDA profitability, which it hopes to sustain going ahead. Ritu Singh speaks to its co-founder Chaitanya Ramalinga Gowda on the numbers and more. Take a look.
Well, thanks for that. Direct-to-consumer home and sleep solutions company Wakefit has entered the 1,000 crore rupee plus revenue club and has also returned to EBITDA profitability for the financial year ending FY24. Now, going ahead, it aims to get to a double-digit growth for FY25 as well and will be doubling down on its omni-channel expansion strategy. For more on the growth numbers and the road ahead, I have with me its director and co-founder Chaitanya Ramalinga Gowda. Chaitanya, thank you very much for being with us here on CNBC TV 18. To begin with, what got you to that 1,000 crore plus revenue number? What were the key drivers, and will you sustain this momentum going into FY25?
When 2022's period came in, which was a very tough period for all startups, we doubled down on the frugality. We said we still have to grow at double digits, but we have to ensure that we get back to profitability, which we had lost out when we entered the furniture category about 4 years back. So that was the focus. How do we grow double digit and yet be profitable? And for that, 2 or 3 things played out very well. Number one was the growth in furniture category, where we were able to launch new products that delivered a strong cross-sell with our existing mattress products. So nearly 40% of all of our furniture buyers were mattress product buyers in the past.
I see.
So that really...
Brand loyalty.
Brand loyalty. Sort of a... Think of it like Wakefit building a pipeline into the consumer's home. And after the first product gave a good value, they were willing to trust us for a larger share of wallet. The second thing that really helped us was getting into the retail channel. We were reluctant adopters of retail.
Offline retail.
Offline retail. We were always online. So about 2.5 years ago, we ventured into that, and we continue to see a strong growth there.
How soon you return to, do we see you return to PAT profitability?
The focus is always on EBITDA and cash flow, because PAT is nothing but what happens after EBITDA, which is depreciation. As a full stack manufacturing entity, we operate about 7 factories across the country. So there is a certain amount of depreciation that does come in, but these assets are built for the long haul. 10, 12 years is their payoff period. So we are very content that certain depreciation will hit us every year, but as long as we are cash generating and we are EBITDA positive, we are content to run it very steadily.
All right. You spoke about venturing into offline retail in 2022. You've already got about 80 stores, and you want to scale that up to 120 in just the next few months. What is the strategy there? How much of the sale are you seeing incrementally come from your offline centers versus online? How will you play this going forward?
We have stopped tracking individual channels.
Really?
Yes. As an omni-channel...
But you're putting a lot of money going offline.
I'll tell you why. It's not because we don't want to track metrics. It is because there's a better way to track metrics. What we realized as we got into this new channel was that we already had a D2C website. We are already present on multiple marketplaces. Now we've gotten into our own stores. So each channel leader was chasing a local maxima when it came to revenue and profitability goals, which was not necessarily good for the company. So what we have started doing from the last 24 months is to track company level what should be the sales and marketing costs, what should be the channel direct selling expenses. Because customers are extremely thoughtful about researching in all places, but they're not loyal to the point of purchase. As a company, we don't say each channel has to be profitable, but at aggregate, we have to be profitable.
So mattress and sleep solutions is something you've been doing for a while. Furniture is relatively new. It already contributes about 30% of your sales. Just give us a sense of how that business has been. What is the rate at which it's growing?
Furniture, given the smaller base, is growing much faster. It's almost growing at double the pace of mattress. Last year was nearly double. Today it is slightly lesser. But given that base, we continue to see 30-40% growth year on year in the furniture category. And mattress is again continuing to grow healthily, but at a lower pace than this.
So tell us, before we end, what FY25 would look like. You've crossed this milestone of 1,000 crores of revenue. You're EBITDA profitable. What would the end of FY25 look like?
We hope to deliver 2 or 3 things. We don't like to take on 20 things. We're very focused. Those 2 or 3 things is number one, can we double down on omni-channel and add more stores? But get even better, we are already profitable at every store level. Can we improve that EBITDA of the store level even more with focused efforts on better selling, better product portfolio and better delivery experience? Number two is with quick commerce coming in, people's expectations on furniture and mattresses also have changed.
Do people want mattresses in 7 minutes now?
You guessed it. Mattresses, pillows, furniture, accessories, they want it in 15 minutes, they want it in 1 hour.
Okay.
So that behavior is changing. So we will continue to make investments in supply chain to be able to deliver faster. Obviously, mattresses is not possible in 10 minutes, but can we deliver same day? Can we deliver in 24 hours? That's a very big part of investment.
Will that be through partners or your own channel?
It depends on the city. There are nearly 8 to 10 cities where we have our own logistics presence. In those cities, we might take on the burden. In some places, we might continue to work with our partners.
Okay.
The third thing that we want to do is continue to increase the brand recognition. We are probably one of the rare brands where the business has grown faster than the brand's recognition. So we will get it to catch up and drive more awareness and drive more consideration.
Finally, since we've seen a whole host of companies going the public route, you've spoken in the past about a 2 to 4 year timeline. Has that changed at all, or you remain?
Not at all. It still remains the same.
Okay.
We are very happy growing at the pace we are growing. We've got a very supportive board that has no exit pressures. So they're very comfortable waiting, because the earliest investor that came on board is only 6 years in the company, because we were bootstrapped in the first 3 years. So we still have the luxury of time. As the preparation goes live, as we are lining up all the internal ducks, we will figure out when is the right time.
All right, and we wish you the best with that, Chaitanya. Thank you very much for your time here today.
Thanks for having me.